चालू करो ना. Good morning. Good afternoon, sorry. Rashmi Shah here from Dallas. Uh, Thank you for your time. And let's start the webinar today. And I'm going to talk about uh, volatility in the Indian financial markets. Uh, and what do we mean by volatility? And how do we go from here, correct? So the objective of today's event is to understand what is volatility and how we react to it and what we should do to minimize the damage to our financial portfolios. The COVID-19 situation has really taken everyone. Talk about my first slide. Just a caveat, this presentation is meant for only Indian clients residing in India, and it's not meant for investors in North America. Okay, and I'll be talking for about 25 minutes, and then I'll be taking question answers. And feel free to text the questions on the right hand panel of your YouTube. Yeah. So volatility. What is volatility? It is the difference, the swings in the prices of an asset. So the bigger the swing, the more the fluctuation, the higher the volatility, correct? So it's like a blood pressure, correct? Or a pulse, correct? If it's a stable pulse, we say it's a healthy person, correct? But the more it swings up. Now, when we do exercise, when we go for a long walk, or when we are stressed out, our blood pressure or pulse starts working at a faster rate. So that's a volatility, correct? And then, same way in the share markets, when there is some change of event happens and the prices swing, the higher the swing, the higher the volatility. In a simple terms, okay, I'll be trying to explain this from the investor's point of view. I'm not going to explain in the technical language or textbook language, correct? Like in a very simple language from an investor's point of view, and with true real life examples and how we manage volatility and what do we do about it. Now, volatility is to do with risk. What is risk? Risk is there is a risk in anything we do when we don't have a complete information. So like on 15th February or first week of March, when the COVID-19 situation started becoming more and more emerged, nobody knew what is the risk, how much is going to, and where this is going to end. So risk can be defined as a fear of the unknown. So when we don't know certain things, there is a risk. What can happen? So COVID-19 has created not only a health crisis across the globe, it started as a health crisis, but then also exposed the financial markets. Why it exposed the financial markets? Because as the health crisis became an economic crisis where we started shutting down the businesses, the fear psychosis which happened among all the businesses and industries got passed on to the financial markets. And when it got passed on to the financial markets, it became very unpredictable of how all the investors in the world are going to behave and manage this risk, correct? And that's when the volatility became extremely high, and it went to an extent where the world has never seen this kind of fluctuations. Between 15th March, not 15th March, I would say from 1st of March till end of April, markets were extremely volatile. And during the period of 10th March to 25th March, every day the market used to swing 2%, 3% up or down. And that's called volatility, correct? Now, the roller coaster ride. So I'm here showing you a chart that during the month of Jan, the market, this is up, the market, down market. The swing was very small. And then you see wild swings happening. So if you sell one day and buy another day, there could be a difference of 30% in the stock price. And the NAVs of mutual funds was swinging left and right, correct? And this really scared a lot of investors, and how they reacted to it, what they do and what they're supposed to do. There are three different things. So in life, what we are supposed to do and what we actually do, there are two different things. So when the entire world market was doing this way, there was a panic. It was a challenge to understand. So high-term, short-term volatility creates a lot of opportunities. When this kind of fear happens, or this kind of blood, there always creates a mismatch in the market, imperfection in the market. So I'll give you a classic example here, which was brought to my notice just yesterday. The total market capitalization of Zoom, which is an app, just an app, nothing more than that, was $48 billion as of April, correct? And the total market cap, as of May 15th, the market cap of Zoom was $48 billion, and the market cap of the seven biggest airlines in the world, Southwest, Delta, United, Lufthansa, American Airlines, was total less than $46 billion. The seven big airlines and all put together was less than one app. Now this is really mismatched, correct? Now Zoom didn't exist 5 years back. It didn't exist. And even if Zoom app is not there, it doesn't matter. Even today, the world will still function. But imagine if these seven airlines are not there, what will happen to the world trade? What will happen to the world economy? But because of the panic, nobody knew what COVID situation is going to do, and these airlines were bleeding cash. They were incurring losses because they were shut down. Their market cap drastically came down from $200 billion to $46 billion in a span of 15 days. So this is called now you say is it a good buy? Yes, it's a good buy, but I would never recommend anyone to buy one airline stock. You buy a airline ETF. Unfortunately, we don't have airline ETFs in India, but if somebody wants to do, they can buy an airline ETF in US, and you buy a sector. When you buy a sector which is totally mismatched with the reality, correct? You can do very well. Now take another classic example. Oil was in negative prices last month. That if you bought an oil future, you had to pay $35 a barrel, correct? A negative price, which has never happened. So this kind of volatility creates imperfections in the market. An imperfection market creates an opportunities for investors. Now, how do you react to that at that time? That's the key. That's the key in investing. Now, the other situation. Now, let me explain you the Indian stock market compared to the global stock market. So here I have taken Nifty on January 1st was 12,000, Nasdaq was 8,000, S&P 500, Dow Jones and Nikkei. Now within next 15 to 30 days, all these indices hit their 52-week high, which is here. Nifty went to 12,352, Nasdaq 9,718 and blah blah, correct? Now on March 20th, 2020, Nifty was 7,610. So it came down by 38%. Nasdaq came down by 28%. S&P by 34. Dow Jones came down by 37. And Nikkei came down by 31. So basically, Dow and Nifty, both them came down by almost the same percentage. But after 25th March, the market recovered and each market reacted differently. So as of today, if you take, from the market from January 1st, 2020, Nifty is still down 26%, but Nasdaq has gone up 6%. So it was minus 28% down, and from bottom, it went up 34%. It's just below 3%, it's 52-week high. Nifty is still below 27%, 52-week high, and from bottom it went up 19%. Dow Jones is up 7% compared to January. Now to Nikkei is minus 12%. So for all the indices, you see the Indian market is still underperforming. Now you add to that the rupee depreciation. Rupee depreciated by 7%. So Nasdaq is given 6% plus 7, 13% return in rupee terms, whereas Nifty is given minus 26. So there is a difference of minus 39% underperformance compared to January. So they have drifted so much. You take Dow Jones 14, this is minus 26, so there's a difference of minus 40. Why is that such a big wide? So Nasdaq came down and went up both the ways. So volatility was high in Nasdaq too, but Nifty went down. It didn't bounce back that much as compared to that. So I'll give you the reason and explanation why that's happening and what as investors we should do, what it means to us, correct? So Indian markets currently underperforming US and Japan and is more volatile than the global market. Now coming back to volatility can be further defined in two parts. Again, if we zoom down in volatility, the volatility is higher in growth stocks compared to value stocks. So a smart investor, when there is a high volatility, he focuses on not on value stock, he focuses on growth stock. So Hindustan Lever is a growth stock. It is a very high PE. Growth stocks has a very high PE, correct? Avenue Supermart in India has a very high PE. Now, Avenue Supermart also crashed during this time, but it hit 52-week high just 2 days back. Same thing with Google, Apple, Microsoft. They all are hitting 52-week high now, but they also crashed 40% down. And when the volatility is high, smart investors focus on this growth stocks, blue chip stock, and bought them. They didn't buy value stocks that time. Value stocks you can buy over a period of time, good companies over a period of time. So volatility can be further defined in two parts: growth stock versus value stocks. So when there is extreme high volatility, focus on growth stocks, not on value stocks. Now, again, stock picking at times becomes very difficult. So you focus on growth sectors versus value sectors. Again, you do that, correct? So, and you'll see what happens. Now, what is the reason for volatility? So now how this volatility got created. So let's take the COVID-19 example from where it started, correct? So it started from health crisis. Because a health crisis came first, that started emerging in the month of Jan. In Feb, we went to global lockdown. So that took the second step. And then because of global lockdown, we went to economic crisis. When economic crisis came up, we went to financial crisis. The asset prices started falling. Now from financial crisis, we went to currency and liquidity crisis. So rupee depreciated, correct? Now there was a run on debt funds in India, and so liquidity crisis. So RBI and Fed has to inject liquidity and currency in the market. And there's still one more crisis which has not yet come, but it may come in some countries, not every country, is a political crisis. Because if they don't manage all this and stabilize the economy, there will be a political crisis. So the reasons for volatility in the stock market is this. Now, India and US may not see political crisis because they have very strong leadership there. But there will be some other countries in Africa or some other developing like Argentina, Brazil, where they don't have a stable political environment. There will be a political crisis. So you have to, the reasons for volatility was, it started from health crisis and then logically it went to this thing. And that's how the market started fluctuating. Now, who started this? From where, who and what triggered volatility? So the first one, they are hedge funds. They were the first one to sell, correct? There are 5-6 different kind of market participants in the financial market. Hedge funds are the first one who create this kind of volatility. They're the first one to sell or the first one to buy. Now, hedge fund does not necessarily mean that they're the smartest guy. They also go wrong and many times they go bankrupt. Not all hedge fund makes money. Their calls can go wrong, but the volatility always starts with hedge funds. Then the day traders and speculators, they are not investors, they do the day trading, and then the herd mentality starts, correct? So that takes the volatility further down. then as the markets go down further, there is a margin call on leverage investors. There are a lot of investors who leverage their position. They pledge their shares, as we had seen in Z Film and so many companies last year. Their pledge shares, when they come to the market, their share prices tank, correct? So it starts with hedge fund, then day traders, then margin calls come, and leverage investments happen, and then net come the retail. After all these things come, retail investors who are watching this, they plunge into it. So they plunge at the fag end of the bear market, or fair end of the fall of the market, correct? They're watching first, and they in the end they start believing it. Then leverage companies, so the financial firms which have leveraged this position of the investors, or this, they fall into it. And finally, investors who have invested for long term in certain mutual funds, certain stocks, they started losing confidence, and when they see this much news every day, they confirm, oh, this was a wrong decision. They don't think beyond 1 year. Now, if you ask any investors today in India, he says markets are going to go down. Why? Because there is a COVID-19 crisis. Yes. Now, it's true there is a crisis, but the economy is not going to go dead, correct? Yes, it's an unfortunate situation. There are some people who will die because of this, but the rest of the people are going to still live, and they are going to still buy products, and the economy is going to revive. So, but when you do investments, you don't look at that way, and it's correct. I'll share the numbers. So what happens is, when markets become volatile, go down, this large, excuse me, sorry, my, okay, one sec. Where did the chat? One sec. Yeah. Yeah. So when this happens, correct, markets are going down, correct? So here, the large cap, this much is the fall, but the small cap, this much happens. The market goes down further, the small caps take this much hit. So the losses are much higher here. The large cap is only this much. So the biggest hit is taken by small cap and mid cap initially, and in the fag end, when the markets are going to turn around that time large caps fall. Now I'll give you another example. So the smart investors, when this kind of volatility happens, they focus on large cap, and at the bottom of when there is a maximum fear in the market, they buy the large cap, and from there the market turns around. So that's what you're going to see. Now, if you take the Nifty, in case of Nifty, the top 10 companies market cap, what is the revenue? What is the market cap? 41 lakh crores, correct? And what is the combined top revenue? It's only 13 lakh 62,000 crores. So for every $1 of revenue, the market cap is almost 3.5, correct? So 3 times. But if you take the bottom 40 companies, the market cap is less than the total revenue of the companies. So for every $1 or 1 rupee of sale, the market cap is 75 paisa. Here, for every 1 rupee of sale, market cap is 3.5 rupees. So these large companies, when the volatility is extreme and there is real blood in the street, people buy the large cap, not the small cap stocks that time, or the sectors, and that's how the market revives, correct? That happens. Now, so how do you gauge volatility? So there is a volatility index which has been calculated by the systems and the computers, and which is published everywhere, and they swing, correct? When the volatility index is above 60, it's a good time to start focusing on what to buy, or which sector to enter. And when it's less than 20, it means the markets are extremely bullish, they're overbought. So you have to look, you have to gauge. So there are different kinds of index. The volatility index for US stock market, volatility index for Indian stock market, and we have to look at that way, correct? And they signal good time to. So when there's extreme volatility, negativity there, it's oversold, it's a good time to buy good stock or good sectors and start investing in that. So how do you, but actually the retail investors, most of the investors, 95% investors worldwide, they think exactly opposite of what they do. So we always say what we think and what we do are two different things. So what we think and what we do, if they're in sync, and they are sync, it's a rational thinking. So we are in the business of, we all, every investor is in the business of creating a wealth creation, not going short in the market or not playing the market, correct? But the investors do at this kind of this is the way the market is swinging up, going down, and going up again. So when it was up, they say, oh, I need my bank deposits are not giving that return. The stock market is giving good return. So they are bullish and they invest that time, large amounts, because they have seen historical returns here of 1 year, 5 year, 10-year returns are very good. I'm getting 7% in bank FD, and indexes have given 14%. So let me go there, 20%. They invest large. When the markets are coming here down, they say, oh, fixed deposit is giving better return than my stock market. I should have kept in the fixed deposit. But technically speaking, this is the time to invest. You get the maximum return here. When you go higher potential for profit, there is a higher potential for losses here. But investors, majority of the people worldwide do opposite. So if you understand volatility, higher the volatility, more the fear, more the blood on the street, that's a good time to invest, and you have to think about it. So now, yeah, one sec. So last 30 years, I'm taking the volatility index, correct? If I take the volatility index for last 30 years, this chart shows every time whenever the index was at the bottom, after that bottom, in next 3 years, the market gave 100% return. So if you take the example of 2008 lemon crisis here, in 2008, it doesn't matter in what day you invested. 2018, in 2008, the BSE Sensex was 8,000. In 2018, the index was 28,000. Doesn't matter. Now, Dow was 7,000. Dow was 13,000. Correct here. So 2002, it doesn't work that way. And imagine if anybody had shorted the market in 2008, someday he would have got trapped and got killed in that. Correct. But he would have been better off investing on any day on 2008 and made a lot of money. Same thing is going to happen in 2020. In next 2-3 months or 1 month, whatever we see, the news is going to be bad. Okay, headline news every day in 2008 was bad. On TV, Economic Times, CNBC, this institution is going bankrupt. This Citibank came down from $100 to $1. And from $1 it went back to $60, 60 times returns. So this is the same opportunity we are going to get in Indian stock market in 2020, correct? So this is how you look at volatility. Now your next question is, why is US market rallying more than Indian stock market, correct? So if you see this, I'll show you the coronavirus. The stock market doesn't like uncertainty. So in 15th March, nobody knew when lockdown was announced in India, lockdown was announced in US, nobody knew how much impact and how much damage coronavirus is going to do. By 30th March, the US figured it out. By that 15th of April, the infection will be at peak and then it will slow down, and the maximum 200,000 people will die. 2 lakh people will die in America. So from 20th March, the market knew that what is the maximum damage the coronavirus is going to do. So the certainty became, and market started rallying. Now, same thing was not true about India. The market, and secondly, the Fed in America pumped $10 trillion in the market. So they have the financial power. India is unfortunately a poor country compared to America. And Indian didn't have that kind of money power, so they could not pump in that kind of money. They did some reforms, and they are trying to help. And so what India did, they created some long-term path. Short-term, they didn't have that kind of money what US had. And secondly, we didn't have the certainty in March, April that how when is Corona going to peak? Now today I was just reading the report from World Bank that Corona is going to peak in India around 15th June. Around 15th June to 20th June is going to peak. In US it peaked on April 15th, correct? So you saw the rally in the US market. The same thing you will see in the Indian market. The same thing you will see in the Indian market. And then that time focus on the growth stocks, growth sectors. Which are the growth sectors? Banking and financial services will be what technology is to America, banking and financial services to India. So in America, in Dow Jones, which is the most popular other index, Nasdaq. In India, after Nifty, which is the most popular index, Bank Nifty. So India is known for Nifty banking systems, and America. So you focus on that sector and you'll see a big rally there. India always follows the US market for last 30 years. After India opened up in 1991, for last 30 years, I've always seen there is a ripple effect of what happens in America, happens in India with a certain time gap. You will see the same thing happening this time also. So in 2008, this market went down here like this. And same thing happened in India too, correct? So you will see that ripple effect happening in next 1 month, 1.5 months. Now, as I said, as markets go down, you focus on growth stock. Growth stocks are also extremely volatile, but they are good companies. Now, I'll give you a classic example. Companies like Amazon, companies like Google, Apple. Now, Amazon came down from $2,000 to $1,800, and today it is back at $2,400 at 52-week high. Same thing with Google, same thing with Apple. So you buy these solid companies. So in same case, you buy solid companies in India, sectors. So in US, if I was in US, I would buy technology sector. If I'm in India, I would buy banking sector, the growth sectors when this kind of volatility happens. Instead of buying a stock, I would buy a mutual fund and go through that, correct? Because my call on the company may go wrong. How to invest during times of high level of volatility? Stick to your original plan of wealth creation. So when economy was going normal, you had a plan. I'm going to invest every month this way, build a portfolio this. You need to stick to that plan. Strategize your investment. Make sure that you have developed a plan and implement the plan and invest globally, correct? Investment partially in emerging markets like India, partially overseas, and always improve the quality. Quality should be the most important thing. As markets become volatile, see, like when earthquake happens, the strongest building survives, correct? The weak buildings collapse first. So when this COVID-19 like situation happens, there is an earthquake in the financial market. That time the weak companies collapse first, the strong companies survive. All cash rich come. If you're buying value stocks should not have any debts. Buy debt-free companies, the value stocks, correct? Don't buy companies with debts in value stocks in this kind of, you'll get killed in that, correct? So this is how you manage volatility, you understand volatility. Now, the other thing, the biggest impact of volatility is how you behave. Your behavior is the most important part. So volatility is very good if your behavior is rational. You buy low, sell high. But if you sell low and buy high, I've seen many investors who have panicked and exit the market and compare with fixed deposit when the market's at the bottom. And they don't compare and they enter the market when. So it's very bad, well destruction, correct? So it's bad for those who try to play the market. Don't try to analyze the market and say, no, I know this market is going to go down. Nobody knows. It's a simple logic. History has proven that when the market's volatile, you buy stocks, invest in stocks or mutual funds, and you'll do very well. Now, these companies, now let me ask you this company, Microsoft, Google, Apple, Facebook, Amazon, same thing in India, you have Hindustan Lever, HDFC Bank, Asian Paints, Reliance. Are these companies ever going to go bankrupt? No. These companies are growth companies and they are going to develop the countries, develop the world, and they are going to change our life. Invest in those kind of companies and you should do very well. You should do very well. And these are the sectors you should do well. Always remember, in times of uncertainty, when there is uncertainty, you get maximum opportunity. When there is certainty, you get minimum opportunity. It's always the best time to invest. As we always say, what is a character? A character is defined not how we behave in good times. A character is defined how we behave in bad times. So your investments also is the same. How you behave, how you invest during bad times, that defines the character of your wealth portfolio. That defines. So same thing in bad times, how your friends behave with you, how you behave, that defines your character. Investments, the same philosophy is there. I hope. Let me share, like every event, I share one knowledge puzzle with you. So while doing this presentation, I was asking a lot of questions to myself, correct? There's this volatility, all economies of the world got impacted. So which is the most globalized economy, and which is the most interconnected economy, and which is the least interconnected economy? And which country has the highest foreign trade and which country has the lowest foreign trade? So if you ask that, most of the people will think US has the highest foreign trade to GDP ratio, correct? So if you take imports plus exports divided by the GDP, you get the ratio of how much is international trade or economy that country is dependent on. So most of us would think that China and US would be the number one and two countries in the world. So I was surprised by that answer when I saw that. The number one country in the world is Germany. 85% of the economy is imports plus exports. Number two is France. It's 65%. UK is number three. It's about 60%. You will be surprised, India is 42%. India is 42% of India's GDP comes from imports and exports. You know how much is China? It's 40%. Imports plus exports. So domestic economy is 60%. Imports plus export is only 40%. Japan is even less. Japan is 25%. Not 25, 28%. And United States is just 25. Doesn't this surprise you that United States 75% is a domestic economy, 25% is international economy? Now, of course, that 25% of $22 trillion is $5 trillion. That $5 trillion is double the size of India's economy. That's a difference. But this is the size. So US, Japan, China, and India are not as internationalized as compared to Germany, France. So this, you understand, when all the countries locked in, who got impacted the most, correct? So this shows you a different perspective. And next week, I'm going to talk about how asset allocation strategies can help you in post-COVID situation of the world. What kind of assets you should have, what kind of asset allocation strategies you should do that. Now, I'm glad to take some questions, and feel free to ask me any questions. And let me see the first question what I have, and I'll be combining the questions. Yeah, so the first question is, what is the procedure to be followed by a normal investor in such a market? Okay, good question. What you need to do is you need to focus on your existing portfolio and see how it's going to play post COVID, and then avoid debt-free companies, avoid debt-free sectors, sectors which has high debt. So, and focus on sectors which are debt-free, and rebalance the portfolio. And do not try to go short. Do not increase the allocation to equity during this time. And this is the thing you have to do. Yeah, and with that, I end today's presentation, and I'll see you next week. And thank you for participating, and thanks for your time. Thank you.